Sweet.
And we're
So,
live. The
super
question is,
duper
what are we
light.
going to call your new podcast, Brad?
It's fucking out. For the one person that always bags on the podcast
Yep.
scene, I don't think
I
this is going to be a podcast. It's just two guys talking shop on camera.
no softballs. Maybe we'll call it hardballs. That's a
But
current show. Hardball is a current show, so we can't use that one.
can't
Trying
use
to
hard
see.
knocks.
Can't use hard knocks, but I mean, got to think of something catchy.
Yeah. What,
Moderators unite.
I mean, I feel you and I are on the phone with each other more than we talk to our wives and
Yeah,
share the
I don't
good, the bad,
understand
and
that
the
though.
ugly. So maybe we just start sharing some of our conversations, deal scenarios, what's going on out there, and have some fun with it.
I mean, there's a lot to talk about. I think we could go on tangents about just the business in general, but very bullish on where we are. I think it's interesting to be kind of involved in so many different networking organizations and associations and having a really good pulse on what we feel like is good information. You know, you and I kind of joke a lot about whether or not what we're hearing is really happening, but the more we hear it from different sources, the kind of better gauge we have on what is happening in the market and on the lending side. And I just think that's interesting because, you know, if you look back, it's almost 8 years ago when we first started. If somebody were to tell us that they were getting X and Y pricing from another company, we would literally look at each other and say, no, that can't happen out there, you know? And now you and I both get calls from associates in the space going, hey, have you heard of this new company? I can't believe they're doing this. And so surround yourself with a lot of professionals in the market. It's a good way to get information about what's going on and
It's kind of
at
like
least
the
being able to call people's bluffs.
yeah, and on the investment side, I call it the mosaic theory, right? So you're taking information here, conversations here, and kind of piecing it together to make your own market call or gauge on what's going on. And shit, we're not perfect. We don't have perfect underwrites, but we kind of stay within our parameters and think it's. We spend a lot of time talking to our competitors. Refer a lot of business to our competitors without asking for anything, but we're just confident in what we do. So when we're green lighting something, it means something, and we're not the best lender for every deal, but we also pretend not to be. And I think that's, I don't know, good, bad, or indifferent. It's just how we
I
do
mean,
things.
one of my favorite things to tell people is, and I think it, you know, you had posted, I think on Twitter or LinkedIn or X or whatever it's called, is like if somebody has to preface with, let me be honest, or you know, I want to be fully transparent. Like, are they really being honest? And I got to tell you, that struck a chord with me because I tend to say that, but I actually mean it. You know, so it's not. But I get the play. I've heard that
But
before
but 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 if you tell me
elsewhere.
you mean it, do you really mean it?
I mean,
I
listen,
mean,
you know, if I'm being
two negatives
honest,
make a positive.
if I'm being honest, I really mean it. And so, you know, from that standpoint, I guess maybe they cancel each other out. But one of my favorite sayings is, you know, there's an ass for every seat, and you know, sometimes you get a chuckle from people about that because they kind of understand it. But you know, we've always been honest with the people that we work with that we're not the most aggressive lenders, but we can be counted on. You know, and being accountable in this business is something that maybe it's a little bit of a slower growth, you know, aspect of it. We don't write checks with our mouth that we can't cash figuratively with our process and our loan structures. And I think you and I have mentioned it before. We lose out on deals when we price things out accurately on the front end, and we hear stories, you know, from other broker relationships and borrowers where things end up changing at the finish line. We just don't have a business mentality, personal mentality of getting a file in just to get it in, knowing that it's going to change down the road. It's just something that you and I have talked about ad nauseum from when we started, you know, started our company. And like, hey, listen, we'd rather have a reputation of being straightforward and being honest rather than kind of doing the maybe if it's even in good faith. So saying bait and switch is only a negative, right? It's not necessarily probably how an account executive or a loan officer intends the file to go, but you and I have enough experience in this business, right, to understand how the file is going to go based on the preliminary conversations. And so it's really one of those things where, if I'm being honest, it's a good thing for us to
I
kind of
think you
kind
hit
of
a
go.
good point. I don't think a lot of bait. I mean, now there's some out there. The bait and switch is freaking clear as day on day one. It's like, no, that pricing's not in the marketplace. That shit's going to change. But then I think for the most part, there's just the markets have moved so quickly, especially with institutional money flooding the marketplace and kind of changing the landscape on some of these structures that are being offered out there. I don't think the loan originator actually has the latest and greatest information on where their loan structures are at as of 10:38 on the 14th. It could have changed
Right.
yesterday, hadn't come out yet to him, and his information's only as good as he's getting. So I don't think all the bait and switches are apparent, but I mean, shit, if you're getting quoted X amount of leverage in the sevens at a quarter of a point, just send me this due diligence deposit on the front end for your fix and flip deal. Chances are you're not getting that due diligence deposit back. And then you made, made another point that we're not the most aggressive lender, which is not. We're not, or at least in our eyes, but sometimes talking to some of these institutional guys or others that primarily do fix and flip or ADU or construction financing. I look at a construction deal, I'm like, holy shit, why would you do a construction deal in California? It takes forever to land that plane. But on the other side of the spectrum, I talk to them on some of the commercial deals we do, and they're like, why would you ever do a commercial deal with no appraisal and non-recourse and no due diligence deposit? I think that's insane. So I think it's like the beauty is in the eye of the beholder. So on one side, some think we don't think we're aggressive and we think others are extremely aggressive, but in their eyes, it's like, hey, we're confident in this structure. But I don't know how you guys do those commercial deals. So it's just finding your lane and sticking to it and calling a spade a spade.
I mean, I to echo that, I think this business is a learned appetite, or a it's like tasting whiskey when you were 20. You're like, why in the heck would I drink any of this? And then as you get older, you let it breathe a little bit, goes down smooth. You can taste the difference between a smooth finish and maybe a peaty finish. I think lending is an appetite. It's kind of a situation where we've experienced it firsthand, right? Where originally we started out as probably, I would say, solely a value add fix and flip type of investing and lending company. We mixed in a little bit of commercial when we first started. And as we get more and more into commercial, you kind of understand the risks of it, right? And so I think a lot of the lenders out there that are focusing on one thing, let's say construction or high leverage fix and flip, as we've experienced too, the institutional lending that has been apparent and kind of bum rushed, the industry in the last 10 to 15 years or however long it's been, right? Probably not even that long. You just kind of understand that they stick to their center cut and what they're used to and what they're comfortable with from a risk tolerance. You and I have talked about this ad nauseum as well, which is that those large institutional, that they have default variances factored into their forecasts, right? And so as a smaller business where we work with our investors, we put an emphasis on performing loans. Our investors are as passive as you can be. We want them to take a look at the project, give us the green light within a short period of time, and then ultimately sit back and collect those interest checks, right? Whereas some of the institutional investors are putting more of an emphasis on volume of money they can get out in a very short period of time, and understanding that, yeah, there probably is there are some deals that will default or not perform as well as they want, but it's factored into a percentage of what they're doing. And so it's all an acquired taste. That's what I was looking for. It's
Velocity
an acquired
capital,
taste.
baby. How many times
Yeah,
can we
man.
chop
So
up this one loan, and it's I don't know, we we rely on mortgage brokers for our deals as a source of deals. We're borrower direct on a lot of the on the residential side, but it's also I think it's part of not necessarily part of our job, but it's always nice to just kind of educate some even experienced mortgage brokers. Here's a heat check of some questions you could ask that lender to kind of help drill down that they are actually one, a direct lender, but two, more importantly, going to deliver on the timeline that your client needs to close. And I think understanding processes is a big thing on what we do. It's what processes do our competitors have in place, and how can we differentiate ourselves? So we could confidently say, if you need to close in 10 days, you can't be using a lender that requires an appraisal through an AMC. Doesn't mean that AMC or that lender is bad or has a bad product. They're just not closing in 10 days. So it's
Right.
asking those questions and understanding what do the responses actually mean on to my loan structure and closing timeline. Um, Pivot, random random question for you.
Oh boy.
What is your one market call last 6 months of the year? I mean, we're halfway through May, and it could be anything real estate specific, whether it's lending, property values, deal profiles, whatever's going on. What's your one market call that might be slightly against the grain on what others are preaching out there?
Wow.
And none of this
I
shit is
think,
pre-rehearsed, so it's just throwing it at you.
I mean, we're going to start with the most serious things. I think the NBA Finals will be between the New York Knicks and Oklahoma City Thunder, and I don't have any bets on it, which that probably gives
Which
me a
leads
better
me,
chance of
when
being
you do
correct.
place a bet on it, let me know,
Right.
and I'm betting the
You
house
just
on
go the opposite.
opposite,
Yeah,
and we'll
I'm
get we'll
telling
be
you.
good.
So, I think that no money is out, so that means that the likelihood of it to come through to make me feel smart is probably going to happen. No, I mean, market from a market standpoint, I like where we're positioned. I ultimately think we're going to see a lot of the same. I think that's kind of a cop out answer, but I'm not a predictor of the market. I just see that I hate the word uncertainty, but the one thing that we are certain of is that there's going to be movement in both directions, right? I mean, ultimately, we've seen that over the last 60 days with all the tariff stuff going on and how the general stock market responded originally and how it's bounced back. And I think you're just going to see that similar thing. I saw something, don't know if it's true. I'm a very much an article headline reader, so I don't really get the clickbait to where I read the meat and potatoes of it. But
The
a
world is
buddy of mine
ending
who's
as we know it.
a buddy of mine who's in the loan business posted something I think on Instagram where there's I think it was 60,000 listings or 600,000. I don't know. I don't quote me on the number. However, there's a certain number of listings and we haven't reached that level in the last 3 years. So what that means, I don't know. I think it's very centric to the markets that you're working in. I think in my local market in North Orange County, I'm seeing a lot more properties that are listed. Now, does that mean that there's stress in the market? Does that mean that people are trying to cash out on the equity that they built up since the COVID appreciation era? Who knows? Does that mean they're in a tough spot? I I don't know if anybody really knows the answer to that. I think there's a few people that we follow on different social media platforms that point out, Florida is a very different type of market right now than Southern California, where there's a massive amount of listings. You're seeing a lot of those tertiary markets, I like to call them, whether it's Big Bear, Lake Arrowhead, Joshua Tree, or Airbnbs in, the Southeast and stuff like that that are hitting the market that, people maybe, I guess, outpunted their coverage on what they're trying to do, not necessarily performing the same way, but properties have appreciated. So now they're trying to cash out a little bit. So either way, I mean, I have no idea. To me, I wake up every day. I think, how do we service our clients? How do we motivate our buyers to find quality deals and mitigate the risk? A lot of our clients take us up on the offer that we have for everybody out there, which is call us on a deal so we can run through the numbers and kind of look at the hypotheticals. What I've been doing, what you and I have done since even COVID. People looked at us like we were crazy during COVID, but we would underwrite the deal and say, hey, I know you think ARV is going to be X. There's a couple of comps that come in, 2 to 5% below that. What does your deal look like at that number, the lower number? If you're good, hey, it's probably worth it to try and take a look at it. Now, in COVID times and a couple of years, maybe 18 months after that, people would see a 3 to 4% appreciation a month on those properties. And any bad decision they made on over rehabbing or spending more money or taking longer, they
You look
would
like a
reap the
genius.
rewards. My
It's like
God, they would reap the rewards and make so much more money. But we saw that unfold in a negative way when interest rates spiked, when people were taking longer. The city was, whatever city they were working in, were taking longer on approving things and getting sign offs. And now all of a sudden they were taking huge baths. And I kind of say it jokingly because I don't want anybody to lose money whether they're working with us or they don't. At the same point in time, the dialogue between how much people and the market loved their properties during the craziness that was COVID and immediately after, versus when interest rates were spiking and people not understanding why people didn't walk into a property and love it. And the common denominator is like, that's an emotional response. People love what I do. People love what the work we do is top tier. It's better than anything on the market. Everybody loves what we do. And then all of a sudden they don't love what we do. No, that's all sentiment in the market. When it's crazy and you feel like you have to write an offer on a property to be able to get a property with a mortgage that's sub 3% or even sub 4%, and now you fast forward to a higher interest rate market, people are going to be more particular. It has nothing to do with your property. It has to do with the sentiment in the market. And so what we've seen is underwriting deals conservatively for our value add clients is very important, right? It allows them to put a
you say
strict
conservative,
ceiling.
cutting you off, when you say conservative, what do you mean by that? Because I
I
feel
just
that
mean that
shit
we
gets
look
thrown
at,
around loosely online, but you actually mean it.
yeah,
In all honesty, I think,
yeah,
if I'm
right.
being honest, I think you take a great approach. No, but when you say conservative, what are you
Yeah,
doing? You stress testing shit? You doing ARV,
yeah.
stress
No, I
test,
mean,
rehab? What are you looking at?
we tend to be conservative on all, or at least I do. When I'm talking to clients, I tend to be conservative on all fronts. Somebody tells me it's going to take them 3 months to do a project. Okay, cool. Let's look and see if you have a 5 or 6 month hold period. What's that going to do to your numbers? If you think your after repair value is going to be 750, and there are 2 or 3 comps that support that after repair value, but there are also 2 or 3 comps that support after repair value of 700. What does it look like at 700, right? And so the goal would be, I don't necessarily believe that the client should see a home run deal at 700. I think it's a pretty big misconception about when we look at things conservatively, right? You're probably not going to get your offer price accepted if the deal is a home run at 700, because there are plenty of investors out there that are willing to pay a premium banking on 750. The question becomes, what does it look like? If you have your cap on your purchase price to where it needs to be, and it just so happens that your project takes a couple months longer, or your property doesn't take longer and it sells for a lower sales price, are you still in the profit, right? That number is not going to look appealing if you went into the deal with an expectation of making a minimum amount. I don't expect that lower after repaired value to hit that minimum, but the goal would be to say, hey, do you live to see another day? Right? Because you and I have seen in this business plenty of times, whether it's interesting layout of the property, whether it's a kind of a unique location within that zip code. And when I say unique, we don't do rural, we don't do dirt roads, I mean, you're across the street from commercial buildings, or you're on a little bit of a busier thoroughfare in that neighborhood. You have access through an alley. There's a million things that can happen. During the peak, those things didn't matter. People were buying properties because they felt like they had to. Right now, people are being a little bit more particular. So what does your deal look like? We have plenty of clients who will say, well, if it sells for 700, then this deal's not worth it. Yeah, but do you feel like it will, is the question. The question isn't necessarily, will it sell for 700? The question is, are you going to be okay if it sells for 700? Because if you are, and mentally you're okay with the possibility of that, you're not happy about it. You're not saying this is a slam dunk deal that I would do every day, but you're kind of mitigating the risk on the downside. And ultimately speaking, what I think I guess the biggest would be kind of generalizing, but one of the impeding factors that institutional investors and the secondary market lenders out there have put on this market is they're just looking for that 1 or 2 comp that is going to prove the highest resale value to make their loan work. And what we've seen time and time again, I mean, anytime we lose a deal, you and I talk about it, I'm going public record. I'm seeing who the lender was. I want to know what the total loan amount is. I want to back into what that structure was on the front end. There's a couple things that you and I talk about post closing that really happened there. One is, man, that's a crazy loan amount. Two is, if it's really, they sent us a bid for X, there's no way that is the end up rehab amount that they ended up sending in, because otherwise they're doing 98% of the purchase and 100% of the rehab. We know this lender won't do that. So you kind of get to the bad actors out of the way. But what we see consistently is when you're only looking at glass half full, let's say on a fix and flip loan, and your loan is contingent on that highest value, you're not considering any downside risk. And with those uber aggressive loans, you have open yourself to the potential of having to bring in cash to close on the resale. And like that sounds crazy, but it happens a lot more than I think the general public realizes, and a lot more than people want to
And,
lead to believe.
and I think you make a good point, something that should be said louder and more consistently. Just because your lender is willing to grant you X amount of leverage doesn't make it necessarily a good deal. It may fit their parameters, but doing basic math stress says, hey, not very often will a flip be completed in 3 months and sold off your plate within four. So what does that 6, 7, 8 month hold look like? Renovation budget goes from 100 grand to 150 real quick. Very rarely do we see a renovation on budget and on time, which delays the closing, and then agent commissions on the back end, closing costs. A lot of things we've seen where borrowers go kind of forget about how tight those margins can get on the back end is factoring in some of those costs, the marketing costs, the staging of the home, things that aren't really factored into that rehab budget. And it's, I don't know, that's 75% ARV. I've seen even 80 marketed, requires a absolutely perfect, beautiful rehab bid,
Execution.
listing, execution on time, and that appraisal better be damn accurate. And we see appraisals trade within 5% margin of error. I think that's not unexpected because
It's
each neighborhood,
normal,
as you're
right?
as you're touching on, is so different. That style of rehab is different. The end buyer will be different. So you factor in that 5% there, holding time doubles, rehab goes over budget by 20 to 30%, which is normal on what we've seen. Just labor is the biggest X factor, I think, in rehab budgets that gets miscalculated. Quality of work, needed to redo it. So that's 75%, 80% ARV, that 20%, the margin goes real quick. And then to your point,
Oh,
having to
big
come in
time.
with having to come in with cash to close a sale. So, is that
Well,
leverage sustainable? So I asked you your market call. I'll share mine. It'll be quick. It's when we joke around about this. It's very rarely do you have a headline where you have a developer or a real estate mogul that has been successful over a 10-year run. Sometimes real estate investors start small, they build up, they're doing extremely well, and then it's like, now I'm going to build some houses. Very rarely do they make that jump, or what we've seen, in small sample size, but do they make that jump into full-blown development and make it to the other side in a better spot than when they entered. It's so I think real estate investors looking to acquire projects, I think there are going to be broken projects hitting the market the next 12 to 24 months. We funded one in January where our borrower sourced one, where you have investors going all in on the ADU play, especially in San Diego, moving target on how that's actually going to play out. But I think you're going to have some ADUs 50% complete, front unit renovated, or projects 50% built out, borrower run out of money, delays with the city, lender, institutional no longer willing to grant an extension, and there's no room for a refinance to save that sinking ship. All markets need to do are trade flat for this, I think, scenario to play out, and they're currently have been trading flat year over year in most markets. So I think that high leverage speculative construction financing at 70, 75, sometimes 80% of the ARV or stabilized value, markets trading flat. Not a lot of those planes are going to land very
oh
smoothly.
yeah.
I think there's going to be broken projects that experienced investors could come in and acquire. Uh, this is before NODs are filed, any of that. One thing investors could keep an eye out for are for lending companies. Once they start hiring for asset managers, I
Huh.
mean, we write loans, we don't manage assets. So if they're hiring or growing an asset management team, that tells me there's some pain on the balance sheet or coming down the pipe of problem loans and properties that they're going to have to work out. This is not a market doomsday call. This is something I've been pretty vocal on over
Always
the
so
last year that
negative, bro. Jesus.
shit, I know. But hey, if you're a real estate investor looking to acquire a broken deal, we will be there to finance it for you.
I
If you're an
know.
investor in a sinking ship with no liquidity and no equity, we will not be there to save your deal. We'll just call it how we see it on
Well,
that.
so I think there's a couple things to kind of jump into just a little bit more detail on that. One is why do lenders, and maybe I have my insight on this, but I'll ask you a question and kind of flip it. You said something like, maybe the institutional investor is not willing to extend the loan. And so we have loans sometimes that, we're not willing to extend either. What are some of the reasons that people should think of? Because I get this question, or this conversation happens all the time. Well, if the investors are, getting paid on a monthly basis, why wouldn't they want just to extend the loan? They want to make money on their loan, right? And so that's obviously an oversimplification of how the business works, especially when you're dealing with secondary market and everybody who sells their loans off, right? Those large institutional types of investors on the back end, they're expecting that capital to turn over. Their extension process might be a little bit more difficult. But what are the top reasons why people won't want to extend the loan?
Um, Property values falling down, or pulling back, I should say. So the equity they had thought they had on the front end is no longer there. Uh, let's bring it to our space, high net worth individuals, a life changing event where they need that liquidity back. They're not required to extend a loan. They may just want to get paid off on that and move it elsewhere. I think that is one not very common, but one that can happen. Also, strategy with the property. Originally, it was a fix and flip project that's supposed to sell within 9 to 10 months. Now they
Hmm.
put a tenant in there. Hey, I don't want to be a rental loan. Some investors, as you allude to, like to just turn the capital over. They don't want to be. They have a misconception where if I'm in a loan for 2 to 3 years, I'm taking on additional risk being in one property for that amount of time. I'm of the belief if your leverage is appropriate on the front end and the strategy makes sense, locking your money up for a 3 to 5 year term can play out extremely well. Yeah, you're going to have the interest rate volatility, but over the long run, kind of having it steady eddy, not having to redeploy the capital or have idle days, your return will probably be comparable to financing maybe higher, not higher, not maybe, but higher leverage point loans for a slightly higher return. Once you factor in idle days of capital to redeploy, your return is probably less than parking it in a 2 to 3 year term. On the institutional side, to trade for them, these are, and again, I am not a bond trader. We don't leverage institutional capital, but from my understanding, these are kind of packaged up and sold as bonds effectively. Different durations, 12, 20, duration is term of your bond, length of the bond, or length of your loan. So depending on what tranche they're putting these in, or the buyer that paper is trying to fill or place in their portfolio, they may only want 12 month duration notes that
Right.
they're holding 24. On the other side, they may not care, but that loan has been sold off so many times, the final end buyer or holder of the paper, they probably have no idea what's going on with the property. And their loan
Right.
servicer is just following the loan docs to the T and saying, hey, it is due. No extension
Well,
is available. You
yeah,
exercised it. Now we are calling it due on that.
yeah,
But
and that
and
that
that's just
is
tip of the
part of
iceberg on reasons. There's more
right.
to it, and I think we'll have to maybe we'll jump into that next time. And I,
Well,
I thought,
we got to jump into why experience doesn't result in higher leverage, right? We were talking about, all of that kind of stuff. And then if I can just add, I know you got to run for a call. The simplest way I explain to people too is, let's say you're in a 2 to 3 year loan on a value add deal. Pricing was generally different 3 years ago. And so when you look at extending and extending and extending, there's a point in time in which that investor, that capital, that family office, I don't even know if it's institutional or not, they're looking at it going, if we get this capital back, we can lend it out at a higher rate of return, and we can kind of reset and underwrite to our updated underwriting guidelines so that we can kind of get this quote unquote risky deal that, like you said, maybe not going according to plan, timelines, overruns, all that kind of stuff. We can get it out into a fresh new deal at a higher rate of return and kind of reassess the risk on a new transaction. So the extend and pretend, right? Extensions on loans, they don't just come down to, is the investor receiving the capital? Because that's just it's a minor, obviously important factor in deciding whether you want to do an extension. But at the same point in time, how much can you get the capital out for today? At what kind of rate? At what kind of risk? And I guess we'll leave it at that. But
and
next up,
then
we'll talk about that kind of in more detail.
that, problem deals where we see borrowers go wrong, where investors could invest, um, kind of eliminating the bottleneck on loan submission process. I mean, we've got a shit ton to run through, and I thought of a name of this, the the non-podcast podcast show or something like that. I don't know.
Yeah, I don't know about that. I don't think that's really good, you know. I don't think that. I was thinking, the shit that we're gonna run through might be a better, hit than
Oh,
that. I don't
yeah,
know.
I like it. I like it.
I
Well,
don't know. Maybe
I'm a
we'll go
numbers guy.
no name podcast. No name podcast. 30
Yeah,
minutes
I
on the
like
dot.
it.
All right, let's rock and
Fucking,
roll. All right, man.
all right,
Bye.
later, dude.